Hello, welcome to the Bankers Africa programme. This is the second in a series of roundtables discussing the issues of financing in Africa, sponsored by Standard Bank. My name is John McCarthy, I'm a contributing editor at FT Business, and today's discussion will be on African local currency capital markets. Around the table today, we have Florian Hartig, Head of Debt Capital Markets at Standard Bank, Starla Griffin, Managing Director Europe at the Emerging Markets Traders Association, Dr. Abraham Nwankwo, Director General of Nigeria's Debt Management Office, Jan Dane, Head of Africa at Ashmore Investments, Richard Fox, Head of Middle East and Africa at Fitch, and Keith Gubbing, Director at Africa Asset Management. I wonder if I can start off the discussion by asking the question of when and why have local currency capital markets emerged in Africa? And I wonder, perhaps, Florian, if you would start us off on that.
Yeah, thank you. I think the situation with local currency markets is a very interesting topic in general, obviously, for Africa. We have very different countries with very different developed local markets. When we're looking at countries like Kenya, for instance, where the local markets have been traditionally very strong, and other countries which have caught up very quickly, very rapidly over the last few years.
What are the rewards available here?
I think I would just add on a little bit more on perhaps a few more points on the emergence of these markets onto investors' radar screens. So I think there's a combination of sort of external and domestic factors that have been at play here. On the external factors, certainly global liquidity, strong commodity prices, a weak dollar, and debt relief have been very important factors. But I think none of these factors would really have been effective in pushing Africa forward unless it had been for the even more important improvements domestically that have taken place. Inflation rates in sub-Saharan Africa have come down dramatically. Many countries are accumulating very healthy reserve levels. Generally, countries have been pursuing structural reforms. Nigeria is a classic case. I mean, one of the best banking reforms that we have seen anywhere in the world. Also aggressive pension reforms that many other regions of within emerging markets are having great difficulty in being pushed forward, are being pushed forward in Africa very successfully. In Nigeria, again, it's a classic case, very aggressive attempts to develop the local markets, to build the yield curves and to deepen the local markets. I think those have been key factors.
Can you give us some examples of the countries that have done particularly well in that field?
I think Nigeria stands out, partly because it's very large, but also because it has so successfully reformed. But others are perhaps less spectacular or less well known. But Ghana has a long homegrown reform program, which has led to an enormous improvement in credibility and in stability within Ghana, and has culminated very recently in the issuance of Ghana's first sovereign global bond, which was very, very strong, warmly welcomed by the markets.
Mm-hmm. Richard, what are the rewards that are available to investors in local currency markets?
Well, obviously, in the present climate, a lot of the interest is being attracted by yield, and it's as simple as that. But obviously, there's diversification issues as well. And I think that explains a lot of the interest in Africa. I mean, the macroeconomic improvements that are taking place there are significant, and that explains why we've been rating so many more countries in that region. The countries themselves are looking to establish themselves in investors' minds. Sometimes the only reason that they come for a rating to put themselves on the map, but clearly there are other reasons as well. We've seen the new issue recently from Ghana. I'm sure there will be others before the end of the year. So diversification and yield in an environment where people are looking to for new frontiers, I suppose, for their investments.
Abraham, would you like to add anything at this stage?
First, on the issue of the reasons for the emergence of the local currency markets in Africa. But a third one to mention is the issue of the historic circumstances. Take Nigeria, for example. Early 2000s, we were concerned about the external debt overhang. And the challenge was to make sure we exited. But also that brought to the fore the problem of inefficiencies in the past. So that reminded us as well to think in terms of improving the efficiency of the domestic debt market itself.
Can we move on now, perhaps, to talk a bit about the relationship between local and hard currency investments? I wonder, how can the optimum mix of local and foreign currencies for primary bond markets best be determined?
This is Richard Fox from Fitch. I mean, a lot of people have tried to answer that question, and most debt management officers will have their own particular view, and the answer is that there is a spectrum. But from our point of view, it's quite interesting. If you look at countries along the rating scale, you will find that the higher up the rating scale you go, the less dependent countries are on external finance, and I think that's another reason to encourage the development of local markets.
Keith Gavath, just to add to Richard's comments. I mean, the way we look at it is on a project-by-project basis is there are three sources of funding. The first is external, which is us going in the first place to actually get the thing up and running. The second actually is external, but from local people. So there's a big diaspora, both Nigeria, Ghana, Kenya, with a lot of money going back, either remitted as hard currency or local currency savings. And then once things are up and running, we tend to tap into the local market. And there's no real formula. I mean, there is a great deal of liquidity in sub-Saharan Africa, especially Nigeria and Ghana nowadays. And we find actually it's a lot easier to tap into the local currency rather than put in a shed load of dollars. But really, it's the dollars that get things going, and then we start working with local currency as soon as we can.
Florian,
just one additional comment. In industrialized countries, the depth of the domestic market is about 50-60% maybe of GDP as an average. If we compare this to what we have in Africa, obviously it's a huge gap. So the growth potential is phenomenal.
Abraham, can I come to you and ask you about Nigeria's view on this and how the sovereign risk ratings have changed, for example, in recent years?
On the issue of optimum mix, at this stage we're still looking at it from the broad point of view. We go beyond the trade-off between and the arbitrage between foreign and domestic interest rates as a major determinant of whether you would like to have more domestic as against external borrowing. At this stage, I'm focusing on the issue of even if an optimum mix is determined, we still will want to focus on the priority to develop the domestic bond market as an objective in itself. So regardless of the relative costs between external and local borrowing, we would rather have the domestic bond market developed as an objective in itself. That's one point to make.
Yeah, and I can see you agreeing with that.
Yeah, I couldn't agree more. I think this is absolutely the right set of priorities. I think there are constraints, though, and I think it's useful to get the investor perspective on these objectives as well. I think the objective of developing a local bond market is absolutely critical, but I think there are some constraints on how fast you want to do that and to what extent you want to develop the local market. I think one particular constraint is the depth of the market itself onshore. What often happens is that foreign investors who at the margin are the buyers in this market will come in and will buy local instruments, partly for the yield, but in Nigeria's case, the yield has contracted so much that the yield is now less of a concern. Now they're principally coming in to take exchange rate risk, right? And this does present an issue because the moment that the exchange rate turns, all these investors will go, right? Because that's why they're there. So what that means is that the local institutions themselves become the buyers of last resort in the event the exchange rate turns. And so looking at the depth of the local institutions should be, I think, a general guide to how big and how fast you want to expand the local market. When it then comes to your external financing sources, I think you have a richness of choice here. You have the donors, you have the market, and you have China and other investors.
I mean, you've brought us on very neatly to our next question to consider, which is what is the trade-off between high interest payments and exposure to exchange rate risk?
Well, in the ideal world, you have high yield and a good prospect on the exchange rate. But couldn't agree more to what Jan just said. I mean, Nigeria has been a great example where in the past, as little as 12 months ago, you had a bright future on both sides. Nowadays, it's really down to the FX prospects, and I think, in particular, given the latest implementations and announcements by the Ministry of Finance of Government in August with regards to cutting 2 zeros from the exchange rate, and then also help on the regulatory side with regards to opening the market up for easier convertibility. I think these are all great things which naturally boost the currency. But I think before too long, people will probably feel that the bigger countries, Nigeria and Kenya, might not offer that much of appeal, still being attractive, but there might be other countries which are more appealing even, and that will clearly help the second and third tier countries in terms of size to follow suit.
Yeah, one element I'd like to inject into the conversation at some point is about, we've been talking about the depth of the local market. I mean, I think another important issue is the depth of the foreign currency markets, and this brings us back to foreign exchange risk. I mean, the last thing you want to do is to encourage, for example, foreign participation in local markets where you've got a heavily managed exchange rate, because that's where you do get these one-way bets. You get lots of speculative money coming in, and then when there's a problem, it all goes out again.
Yeah, I think the flip side of that, which actually supports your view, is what's happening or what has happened over the last couple of years in Zambia, with the so-called Kwacha round trip. We had substantial investment in the local T-bills, which were then reversed within a few months, and we had massive moves in the exchange rate because the amount of foreign inflows and then subsequently outflows when the bonds matured were very sizable compared to the size of the local FX market and the willingness on the part of the central bank to intervene. And this imparted a considerable amount of exchange rate volatility onto exporters and importers. It became, for a while, a political issue with the non-traditional exporters from Zambia.
I'd like to move on and to talk about some market considerations now. Perhaps I can throw this question out to the table. What is the effect of weak public debt management on African bond markets?
I mean, debt management, management of the debt that you've got and changing its profile and its maturity is one thing. I mean, I think in some ways a more important issue from a rating agency perspective is how much debt to actually have in the first place, and how what is the sustainable level of debt. And I think that's a very difficult question, and it certainly varies from country to country. But it's unusual in your typical emerging market. I mean, around the sort of low investment grade, high sub-investment grade level to have more than sort of 30 to 40% of GDP in total debt. Now, I mean, we're talking about a lot lower than that in some. We wouldn't want to get to 30% of GDP overnight, certainly. So I think there is an issue which people have started to think about very carefully now. Now that a lot of these countries have had their debt relief, they start off with very clean balance sheets, with apparently lots of potential to increase debt issuance locally. But there is a speed limit, I think, as to how fast you go and as to what level you get. And there is definitely, questions to be asked about how much to rely on local markets and how much to continue relying on traditional forms of finance.
Can you give us an example of a country of your choice that illustrates?
Well, I mean, Ghana is interesting because, Ghana has just become the first sub-Saharan African country to issue a Eurobond, 750 million last month. That was a lot of money for Ghana. And it's not the sort of thing it can do year after year after year. I mean, it's very much a benchmark issue, sort of earmarked for certain projects. There is still going forward going to be the problem of how is it going to finance its infrastructure needs, what sources of finance are available.
Jan?
Yeah, just to make 2 points. I think with respect to public debt management, I think it's sometimes easy to lose sight of the forest by focusing too much on the trees. The big step forward in public debt management in Africa was to go through, basically torture to achieve debt relief. These countries went through some tremendous structural adjustment, fiscal adjustment programs that were sustained over a number of years in order to achieve substantial debt relief. This is by far the biggest issue in public debt management in Africa, and African governments have delivered. I think one can make the mistake, which is what I think the donors have been making for many, many years, of wanting to put in place a perfect system, which ideally then is unleashed, and then the markets suddenly appear from nowhere, and presto, we have development. Learning by doing is one of the most effective ways of moving forward.
If I could just add to both Jan and Abraham, not on a bond level, but on a much more private level, we've identified certain requirements that actually make our life easier, and we're trying to address those by going to the capital markets and working on the PPP type route, so that it sort of bypasses the government, bypasses the central banks, although we work very closely with them.
Another question that falls broadly under this heading is the lack of longer-term African securities. Can somebody explain why this is, and what effect it has, and perhaps what prospects there are for change in the medium term? Florian.
Well, I think if you differentiate between the domestic markets and the international markets, first, domestic market-wise in sub-Saharan Africa, only Kenya and Nigeria really have been leading the pack. Others are catching up. I think from an investor point of view, the longer you go out the curve, the more risk is involved, and the more market swings will affect your mark-to-market. So I think clearly interest in longer-dated securities is all about feeling comfortable, feeling reassured permanently about the progress, and you need to be comfortable with your investment. And with regards to the Ghana bond, I think a very impressive transaction. Pricing of this deal is maybe more debatable. Some felt it is too cheap, some other felt it is actually very tight. I think what matters most here that this is a benchmark which other countries and even some of the private sector can really use as a reference, and that was badly needed.
Starla, what are your thoughts on the long-term bonds?
Well, I underlining what Florian has said. When we look at what investors are looking for in markets, obviously we want to see benchmark securities, we want to see longer-term securities, we want to see a proper maturity along the yield spectrum.
I'll just add a small, quite obvious point. You've had years of very poor economic management, high degree of political instability, lack of democracy. All these problems make it completely optimal to invest very short term. As these fundamentals are improving across the board, your investment horizon will expand as well. So I think it's only a matter of time, if you share the positive view of Africa and sustainability of the fundamental improvements, that we will start seeing longer-term instruments.
I thought I would like to learn from the experts here about the development of the domestic bond market with the issue of alternative funding approaches. It can be taken in terms of partnerships between foreign and local investors. It could also be in form of public-private partnerships, so that resources could be mobilized to develop infrastructure, to develop specific commercial projects, and in this way minimizing the risks and the considerations regarding interest rate differentials management, exchange rate problem management, possibilities of reversal flows, reversals, which are usually associated with portfolio investments, which is what dominates much of the bond type of investment we are talking about. So the question is, how would we migrate a little from mobilizing funds through bonds to mobilizing funds through equity and other forms of funding?
Can I just...
Please do.
I'll just add something to that. I think that this idea of creating conditions for more private investment is kind of where everyone is heading. But Nigeria is leaps and bounds, I think, ahead of other countries in Africa, and there are massive funding needs, very basic infrastructural funding needs.
We've spoken once or twice. Richard and Jan have both raised the issue of sovereign yield curves. Can I get a view around the table as to how important establishing a sovereign yield curve is for encouraging investment?
I think those who invest will tell us, because we are trying to establish the yield curve. But essentially, there's no doubt that establishing the sovereign yield curve is important, because it provides us at least some psychological comfort And I guess for many investors, it goes beyond that to provide some real comfort.
Where does Nigeria stand in that process?
As you know, we revived the market for government bonds just in 2003 when we did the blind leap, because for 18 years there had been no bond issuances in the market. And so we issued 3 years, 5 years, and 7-year bonds, and those the outcomes were varying as expected. We then went in a retreat and started working on the fundamentals between 2003 and 2005. It was now in July 2005 that we came back to the market with regular issuance programs on a monthly basis. And ever since July 2005, we have always been in the market every month.
I think we all agree how important a sovereign yield curve is for the domestic issuance. Doctor has mentioned before really a number of reasons why, from a Nigerian point of view, it's important. Clearly, the whole thing is driven by trading, and for investors, for external investors to come into this market, they need to have a clear view as to how to get out of a deal unless they really go and buy and hold this deal. So that, I think, trading needs to improve. Secondary market is great. But let's take a step back and look at the international side. I would like to ask the group here, how important is it for international issuance that the sovereign has come first in the transaction? How relevant is it? Anybody of you?
Yeah.
I think it's a bit like building a house. You want to have the foundations, and in a sense the yield curve is that, but it's nothing more than that. It's everything that it's used for that's important. And I think when you have a new bond issue, the first thing you do is you immediately look at the comparable countries and you say, well, where are they trading? And I mean the most recent case was the Ghana issue, and it was Pakistan and Jamaica. Pakistan was in the middle of a political crisis. Jamaica has got massive debt burden, and so the comparables were not really that great. And what we were hoping for was maybe to have another country in Africa that had similar risk profiles. We didn't, and so the Ghanaians, wisely in my opinion, consulted quite extensively with market participants about where the bond should price, and then they recognized that they're the first in this new group of countries to issue, and so they opted to give a little bit more to investors for taking that new risk. And in the end, the bond came traded 30 basis points tighter, which you could see as a little present to the investors, but it's also a cost to the country. But it's a small cost, and in the end, the bond was placed very well. I think now that we have it, it's incredibly comforting to have that code.
If I look at the private sector and say, what is my reference? Now we have a Ghana transaction. How relevant is it that a Tanzania corporate is pricing off the Ghana? If we take this into the CIS, how relevant is it that a Kazakh bank is pricing off the Ukraine sovereign?
Maybe Richard, can you help us with this? Well,
obviously, this is what the ratings are designed to do, is to allow you to compare one country against another. I mean, and it's quite interesting. You say that in Ghana you were immediately looking for comparable countries with bonds out there. I mean, obviously you've got, as I say, we rate approaching 20 African countries now. So it's actually the African rating group is actually quite a broad one now, a broad spectrum. So there are certainly comparators out there, but very few of them at the moment have external debt issues. But yeah, that's the role that ratings are designed to play.
When we launched our transaction for Guarantee Trust Bank back in January this year, which was to some extent really like there were no comparables out there, and we went on a roadshow and we asked this question to investors because nobody knew the answer, and we wanted to learn during the book building process what is the fair pricing. And at the time, we felt that many investors, not most, but many investors, did not see the lack of the Nigerian sovereign curve as really a problem, because they felt actually that Guarantee Trust Bank could fill this gap in their portfolios on behalf of the sovereign.
Well, thank you all on that subject. I'd like to move on towards diversification, the fifth item on our agenda today. What are the key factors that would widen the investor base and reduce reliance on the local commercial banks? who would like to take on that?
Yeah, I think to some extent the process of developing your investor base is actually quite heavily influenced by the government, by the issuer's own decisions. I think the investor universe is an incredibly diverse space, and it's also a huge space with investors with these very, very different profiles. Some of them want pure credit risk. For that, they need a dollar instrument. Some of them want local currency risk. For that, they can do short-term T-bill markets or just FX forwards. I think governments would generally do well to educate themselves as much as possible about the investor base so that they can say, okay, this type of risk, this type of investor we would like in our markets. In the long term, of course, they want all the investors in there. They want a fully diversified investor base.
We've already spoken quite a lot about how the government bond markets support the development of corporate bond markets. Are there any further issues that people would like to raise on that point before we move on?
One last point on that from my side. I think that international investors will continue to look only at the very biggest name in the country if we talk about local currency issues. So even if the government bond market has been well developed and there is trading activity, I think for the foreseeable future, international investors will only look at the likes of Dangote or so, which are predominant players in the market. Why? Because after all, every investment has to do with a lot of credit work. And the question is, how much time do you want to spend on something on a ticket of $5 million maximum? So it must be worth the analyst's time. And as such, only the big boys can really issue in size and can make a meaningful transaction that attracts the international audience.
You'd agree with that, Stella?
I would, and I would actually take that a little bit farther with respect to actual African countries themselves that are very small. There's some talk about, is there anything you can do to regionalize a bit access by foreign investors to African governments that would be too small to issue on their own? Nigeria is obviously a clear example of one of the only African countries that is large enough to absorb as much supply of foreign capital that's out there. But I just put out to the table this question about the small country problem or the big fund problem, however you want to phrase it. What can we do about that?
Let's deal with that. I mean, this is one of the items here that are some sub-Saharan countries just too small to develop markets deep enough.
Certainly from a private equity basis, we take a regional view. So we look on Lagos, Nigeria, Abuja, covering Nigeria, but also it means we can get into Ghana, we can have a look at Togo and Benin and Cameroon to some extent. From Kenya, we will certainly cover Uganda, Tanzania, possibly Rwanda, Southern Sudan, and even up into Ethiopia. Because, as you say, the markets are just too small to get any sort of critical mass going.
Richard?
I find myself thinking of this latest innovation in South America, actually, the Bond of the South, where Venezuela and Argentina have come together. It's not necessarily a very good example, but clearly there may be a precedent for countries joining together and issuing jointly. I think there is certainly there's some scope for that maybe, but I think it's something where the African Development Bank or World Bank could sponsor something. I noticed that the World Bank have just announced that they're going to set up this local currency emerging market fund. And it's possible that they could do something similar on the foreign currency side for Africa.
How would one establish the equivalent of a sovereign risk rating for a regional fund?
Yeah, good question.
Yeah,
there is this idea of joint issuance is one that we've certainly been looking at for a little while, particularly pertaining to very small countries that could, perhaps under the auspices of the African Development Bank, could issue a very large Africa bond, right? So,
what are the small countries we're talking about?
Well, we're talking about a country like Rwanda, for example. I mean, absolutely tiny. Countries like that, are they going to issue a global bond of 100 million? They're not even going to get in the MB index. It doesn't make very much sense. If you had a number of these smaller countries that could, where the African Development Bank could perhaps launch an African sovereign issue, sort of nice big issue like $2-3 billion, very liquid. It would operate almost like an index. It would capture African risk and form if you wish, a sovereign benchmark for African risk. There are some important, serious technical challenges involved in that.
Adding just a couple of things to that. I think it's also clear when you have a club transaction, there are stronger players and lesser so. The stronger players would kind of get diluted to have an average transaction, averaging the risk in the basket. So I think one way to look at things, or maybe a solution to this, is the African Development Bank has been mentioned before, to get a kind of coupon rollover guarantee by the African Development Bank, which would then naturally result in a higher rating, and the strongest player in the basket doesn't feel that he's carrying the others, but in fact he's participating on the upside as well, or on the credit enhancement as well. Maybe that's an angle, but still the problem Jan mentioned with regards to a default, potentially here there, who is really taking the loss, who is taking the hit, that is, I think, is a big question mark there.
Abraham, we've spoken about Nigeria being big enough in its own right to issue bonds in its own right. But Nigerian states are also wanting to issue bonds. How desirable or feasible would it be for a combination of Nigerian states to issue a joint bond?
First, to start is that in the issue of states issuing bonds, states in the past have actually attempted to issue bonds in the domestic capital market, which is good because to do that they have to go under the guidance of the Securities and Exchange Commission, which has to make sure that their books are in order. But from the debt management point of view, we look forward and we think that states and even municipals should be able to issue bonds in the near future and raise money on their own right from the capital market. And that's why we have taken these initiatives of helping them establish their own debt management units so that they can proactively manage their debts, proactively think in terms of the best way to package funds for their development projects.
Richard,
I was just thinking again that there is another concrete example actually of a grouping in Africa. I mean, there's the East African Development Bank, which is basically Uganda and Kenya, which I think there might be a few others in there as well. But I mean, which we rate, it's a blend of the sovereign ratings, if you like.
In general, one of the things that has somewhat surprised me today is how little we've heard about the influence of South Africa. Can somebody give us an idea of to what extent South Africa overshadows sub-Saharan capital markets, and have we now moved beyond that historical position, or are we likely to see sub-Saharan Africa moving out of the shadow of South Africa? Florian.
Well, yeah, thanks. I'm working for a South African bank, so I should know a lot about that. No, I mean, my personal opinion is that up to very recently, South Africa was really seen as a very, very different animal. I mean, this economy has such a head start over what we're seeing in sub-Saharan Africa. We're talking about a single A rated country, with the exception of Botswana, which is for different reasons also single A rated. I mean, this is too much of a credit differential here. But I think going forward, I think the potential in sub-Saharan Africa is in countries like Nigeria. I'm sure all seen this Goldman Sachs study about what the world economies will look like by 2050, when Nigeria was, I think, number 10 or 11 in terms of most influential economies in the world, and South Africa was way behind that. So, I mean, if you look at this, I think this gap is going to close, at least for some countries, rapidly.
Yeah, I mean, obviously South Africa is something to emulate in the sense of the development of their domestic capital markets. I mean, they are first world capital markets, and that's certainly, a benchmark for the rest of the region. But, it is a very different economy. It's a different credit with its, different strengths and weaknesses. So, I mean, it's obviously big, and therefore it has a big influence on trading relations, particularly in the south of the continent. But, I mean, beyond that, I mean, I think you have to treat countries, on their own standalone qualities.
Mm-hmm.
We're coming towards the end of the session now, but before we do, Starla, you spoke earlier about the impact of the IMF and World Bank. Can you recap those points and throw them open to discussion?
Yeah, this is something that I think is going to be with us for a little while. The IFIs are clearly still around, and the point I made earlier, it was in the context of debt management and concern about use of funds particularly, and the very concerted policy to encourage countries to develop their local bond markets as opposed to incurring more hard currency debt because of exchange rate risk. So I just think that this is something that's going to be with us for a while, and we need to deal with it in some way.
Yeah, I was going to
Richard,
say, I mean, what you're seeing for all the supranationals, as we call them, I mean, not just the World Bank, but also the African Development Bank and most of the others, is they are actually finding it difficult to find projects to lend to. And so, certainly government projects.
Abraham, what's the view from Nigeria?
Yeah, for Nigeria and then for Africa, actually. I think what is emerging is a tripod of conflicts, and with Africa at the middle. From what you can see, there's the World Bank Group and such other multilateral institutions that are concerned about the problems of free riding, the problems of moral hazard, the problems of sustainability, which are relatively objective criteria, and of course, as Dana mentioned, the issue of defending their old turf of investments. That is on one side. Then you have the private sector group, the private investors, who are also interested and who also see that there's a threat from the other group. And then, of course, both of these groups I mentioned have something against emerging countries who want to be funding Africa, and prominently China. They see China as a different animal. And so you have these three groups creating conflicts, and if you like, Africa is in the eye of the storm.
On that note, I'm afraid we must end. I'd like to thank you all very sincerely for your contributions today. You've been listening to a round table discussing issues of financing in Africa, sponsored by Standard Bank. This is the Bankers Africa programme. I'm John McCarthy. Thank you for listening.